Hi guys! Today we're also going to start a new chapter which is called Final Accounts. A super important chapter, also quite difficult because of all the different information that it contains and that students need to learn. So please take this seriously, make notes, and if you have any questions, write them down so that we can discuss them in class. So this unit, we are going to have a look at profit and loss accounts and balance sheets. These are two different final accounts that companies need to produce in order to show information to different stakeholders. We're going to have a look at the purpose of these accounts for the different stakeholders. So what might they use it for? And talk a little bit about accounting. And by the end of the chapter, once you learn how to read the different final accounts, you're supposed to also calculate and prepare a profit and loss account and a balance sheet by yourself. So let's start with the first topic of the stakeholders and in general, what is accounting information? So we know that all businesses are owned by shareholders and they need to provide some final accounts to various stakeholders. Usually the most important stakeholder that is requiring these final accounts is the government, okay? Because the accounts are financial records of business transactions, and the government needs to be able to check these, read these, so that then the government knows how much tax it should require from different businesses, right? This is also the reason why people also hand in tax records, some income statements, in order for the government to know how much tax they should pay the people, the population. And these final records, these final accounts include very essential information. I'm going to show you which ones. They are prepared usually by accountants, and for bigger companies who are supposed to have audits, then they are audited by independent accountants. What does that audit mean? That means that some independent accountant comes to your business and checks your accounts, whether there have been any mistakes or anything. If there are mistakes, then the business needs to fix them. So the independent accountant is somehow responsible for the right submission of these different records. Now, what are the two types? We know that one is the profit and loss account. What does it show us? I mean, from the name, you can see that it shows us whether we're making a profit or whether we're making a loss, and how did we come to this profit and loss. So it shows us also what are our revenues, what are our costs, how did we get to our final result. It's showing, you can show profits and losses made on different business activities. And usually it's showing you the profit and loss for a certain period. Yeah, you can have a profit and loss account. It's usually made, for example, per year. You can also have it per month, per day, per week. However, most of the times, especially when we're talking about business, you're showing a profit and loss account for a year. The second final account is balance sheet. And balance sheet is actually supposed to show you something else. It's a statement of the total assets and liabilities of a business. It shows us how much do we own at a certain moment in time, and at that particular time also how much do we owe. So it's sort of showing you the wealth of a business. The difference between a balance sheet and a profit and loss account is that the profit and loss account shows you what happened per period for, let's say, a certain amount of days, certain amount of months, whereas the balance sheet always shows you only the state at a certain moment on a particular date. as I'm gonna later on explain the balance sheet in more detail, you're going to see that the state of the assets and the liabilities changes from day to day. That's why it's all kind of like a snapshot, like a picture taken at a given moment. Okay, so now let's talk about the profit and loss account. How do we get from revenue to retained profit? From the previous chapter, we already know that retained profit is the profit that business can reinvest back and use it as an internal source of finance. But how do we get from revenue? We are, let's say, selling some products that is going to generate our revenue. What do we need to pay along the way? What are all the deductions that we need to make in order to get to retain profit? So this is what the profit and loss account is going to show us. At the very top, you're going to have revenue, and at the very bottom, you're going to have retained profit. What comes in between is what we're going to talk about right now. It can be, the profit and loss account is going to be split into a few parts, and this is what it's going to look like at the end. So you can see at the top, we have revenue. At the bottom, we have retained profit. And in the middle, we have different things. If we're going to split the profit and loss account, we can split it into three parts: the trading account, the profit and loss account, and the appropriation account. The reason why I put these lines here is that actually we're not just deducting, we're also making these like in between, we're making sums. I mean, this is not a sum, this is a difference. So here we're making some results like revenue minus cost of sales equals gross profit, minus overhead equals net profit, and so on. So it has some information, and also in between, we're always checking for the result. Now, we're going to talk about the different parts separately, but at this moment, please take some time to actually copy down this table into your notes. You don't need to write down the first column, so you don't need to copy the minus and equals, but copy this one, okay? Copy this one, and also copy the data about the finance. You're definitely not going to be finished by now, so please pause the video, finish copying, and then when you're ready, press play again. Okay, so trading account. We're going to talk about that in more detail. Now, the basic information. What does it show us? The profit and loss account. Usually it's produced once a year, as I said, at the end of the financial year. And it's you can have a detailed version for internal purposes. So, for example, you can publish or create the profit and loss account throughout the year, so that the managers can, let's say, check the results. A less detailed version then is going to be available to the public. That is actually one of the disadvantages of private limited and public limited companies, is that you need to publish your accounts. And when we were talking about that in the first unit, that you need to publish your accounts. But now you'll know what that means. What are accounts? So basically, if you publish them, you make them available to the public, anybody, your competitors as well, can access that information. And that is why you don't want to give away too much. So for the public, you create a less detailed version. For internal purposes, you have a more detailed version so that you can actually read the information, work with it. The the profit and loss account shows us the gross and net profit of the company, and how the net profit is then split up between dividends to shareholders and retained profits. It has three parts: the trading account, profit and loss section, and appropriation account, which we're going to talk about in more detail just now. And sometimes it is also referred to as the income statement or statement of comprehensive income, just so that you know when we're mentioning income statement, what it means. All right, now again, straight away to the trading account. The trading account shows us, or the trading account is composed of these three rows. So at the top you have revenue. How much capital did I generate from selling all of my products? That's revenue, yeah? Minus cost of sales. What did it cost me to actually sell the products? So let's say that I'm a, muffin selling company. I'm selling muffins. I make revenue out of the muffins. So then the cost of sales would be all the variable costs, all the packaging, all the flour, all the even direct labor that went into producing the muffins, if you can measure it. That would be all the cost of sales of the muffins. Yeah. The gross profit is showing you how much all the muffins, how much profit did the muffins generate in order to cover your fixed costs. Because at this point, we are only deducting basically variable costs. Cost of sales, it is mostly going to be variable costs here. But the gross profit is very important to know, to calculate, but it still does not account for all my other costs, such as fixed costs, the cost of rent, the cost of electricity, the cost of advertising, and so on. So then we will need to deduct other things. But let's focus on the trading account. Why is it important to know and read and measure the gross profit? First of all, sales revenue is super important. It tells us how much the value of our sales made during a certain trading period. We can be looking at numbers, how the revenue, how the sales turnover changed from one year to another. We can discuss or try to find out the reasons why the sales has either increased or decreased. For example, if we find out that the revenue has increased, we'll look, okay, why did it increase? Did we do something correctly in our marketing strategy? Or did the, trends change? Did the demand for the product go up? Why? What change did that affect? Basically, we're trying to make use of the good case practices that we're doing already. And if there are any bad case practices, for example, let's say we set the price too low, or maybe too high, the revenues went down. Maybe that was a bad decision, and we're going to try to fix that. So that is the information that is given to us, or can indicate some information for us when we look at revenue. The second one, cost of sales. Cost of sales can be used for different purposes. You can be, it is basically the direct cost of purchasing the goods that were sold during the financial year. Here, the formula that you have, it's one way of calculating it. If you, for example, have some opening stock, let's say I have 100. I'm gonna not use muffins this time. I'm gonna use, let's say, toys. I have 100 toys. It can be anything. Let's say balls. I have 100 balls in my storage house. I'm going to buy an extra 300. Throughout the year, I'm going to sell, let's say 200, and my closing stock is going to be how much? My closing stock is going to be, what did I say? 300 plus 100 minus 200. So my closing stock is going to be 200. Yeah. What is my cost of sales? my cost of sales is going to be 200 because I sold 200 crowns or $200 worth of balls. Okay. Cost of sales can also increase, decrease, and we might see, let's say that if our cost of sales is too high, we're not getting enough gross profit, then we might need to find, for example, a new supplier which is going to sell us balls for cheaper. Or we might think, okay, maybe it's not enough to buy only 300 balls because that's not big enough quantity. Our supplier cannot give us any discounts from bulk sale. So we might be looking for opportunities where we can get economies of scale, and so that our cost of sales decrease, cost of sales per unit decrease, and our gross profit increases. So this is the information that is part of the trading account. If you have any questions, please write them down so that we can address them in person during our lesson. And now I want to just show you an example, very simple case study example. This is an example of a typical trading account section of an income statement. As you can see, this is a company called ABC Limited. It's a private limited company, and it shows us at the top that the results are for the year ending 31st March 2013. Don't worry that it's not ending on a December, because businesses can actually choose what is their financial year going to be. When is the financial year going to end? So in this case, it's showing us the year ending 31st of March. And at the top, we have sales revenue, opening inventories, purchases, total inventory available, closing inventories, and only then do we have cost of goods sold. So it is showing us how, we can calculate cost of goods sold in case we have information about opening inventories, purchases, and so on. So we know that at the beginning of the year we had $10,000 worth of stock. Then we bought $25,000 more, and at the end, after the purchase, we had $35,000 worth of inventory available in our warehouse. We know that at the end of the year, when we checked all our products, in Czech it would be called inventura. When we checked our inventory, we found out that in our warehouse we have only $12,000 worth of products. So out of that, we can calculate how much did we sell during the year. So 35,000 minus 12 is going to equal 23,000. So that is going to be the value of my cost of my goods sold, the cost of goods sold. And you can see that that fits the formula that we were giving at the top. And then how to calculate gross profit? What do you think? We take the sales revenue, $55,000, minus the cost of goods sold, which is $23,000, and that equals $32,000. Okay, this can be an example of a question that is just going to ask for part of the profit and loss account, where it also works with stock and inventories, but otherwise. In exams, the profit and loss account is looked at from more macro view. So you might be asked to calculate the gross profit. Now, the profit and loss section, what does that show us? It's the second part of the profit and loss account. It actually shows us the operating profit. The net profit, sometimes referred to as the net profit. So you need to know both of these words. Both of these terms. Operating profit, also net profit. Net, the word net, when you see anywhere in finance, it suggests that something has been deducted from it. So usually the first sum is going to be gross. Then when you make some more deductions, you basically subtract something, then the value is going to become net. Okay, sometimes it's also referred to as the profit before interest and tax, to show where in the profit and loss account this particular result is going to be portrayed. The profit and loss section then shows the operating profit and also the profit after tax of the business. Now, how do we calculate operating profit? Gross profit minus overhead expenses. Now, from the previous units, you should know what are overhead expenses. Sometimes we're referring to them also as the fixed costs. These can be anything from rent to electricity, advertisement, salaries, management salaries, and so on. And the second part that you need to be able to calculate is the profit after tax. That's going to be calculated as operating profit minus interest costs and minus corporation tax. So you need to make two deductions there in order to calculate the profit after tax. Here's a short definition of the overhead expenses. So just to remind you, it's the expenses of a business which are not directly related to the number of items produced or sold. Yeah? So exactly the exact definition of fixed costs. Here you can see the second part of the profit and loss account, which is called profit and loss account. And here we calculate the net profit, sometimes referred to as operating profit, and also we calculate the profit after tax. So just notice how it's structured. First, you have gross profit minus overheads, which equals net profit. Then you deduct or subtract the interest. That gives you the profit before tax, or here, as you can see, referred to as the pre-tax profit. Then you deduct the tax, and then that gives you the profit after tax. Here, notice how sometimes it's not, and this can happen very often in exams, that they're either going to give you a value, as you can see here, or they're going to just tell you that the tax is 20%. So then you would need to calculate 20% out of the profit before tax in order to calculate the tax. Yeah? And then you would deduct that. So this is the second part of the profit and loss account. And the third part is the appropriation account. This part is telling you what? How the profit after tax has been distributed. Whether it has been distributed between the owners in the form of dividends, or whether, most of it or a certain part of it has been reinvested back into the business as retained profit. So it really depends on the owners, like what they decide. If they decide that they're gonna need the finance in order to finance some expansion or some growth of the business, then they're probably not gonna pay out any dividends to themselves and for the good of the business. Or it might be a business that really, has a lot of pressure coming from shareholders, and they will need to pay out a certain amount of the dividends back to shareholders every year. And this is basically what the appropriation account tells you, how the profits after tax have been distributed. If you look here, you can see the numbers that more than a half has been distributed as a retained profit. So they decided at the annual meeting of the shareholders, they decided that 248,000 is going to be reinvested back into the business, and only 200 will be split among the shareholders in the form of dividends. And here's the definition of dividends in case you don't know. It's the share of the profits paid to shareholders as a return for investing in the company. Yeah, it's the returns that the shareholders get for their trouble and for their investment. And now that we know the profit and loss account, we know that these dividends are only paid out from profit after tax. Retained profit, we already know the definition. It's the profit left to the business after all the deductions, including dividends, have been made. And this profit is then plowed back or reinvested into the company as a source of finance, as an internal source of finance. Right, so this is the third part, the appropriation account. Yeah. So that is overall what you need to learn. You need to understand each of these parts, and you need to learn how they come one after the other, and be able to read information from a profit and loss account. Let's say calculate the profit and loss account as well, and work with it in, for example, discussions or in some debates regarding the profits and losses of a certain company. The profit and loss account is used to measure and compare the performance of a business. It gives information to potential investors and creditors and banks, and it can be used as feedback for planning. You can have some expected versus real profit levels. And the idea is that potential investors will know how to read the profit and loss accounts, and they will distinguish between high quality profit and low quality profit. If you're interested in knowing, then we can have a look at some profit and loss accounts and discuss further what might high quality profit mean and what might low quality profit mean. The definition of these two terms is that high quality profit is profit that can be repeated, that is sustainable, whereas low quality profit is one-off profit that cannot easily be repeated or sustained. So let's say, 1 year you have very high profits, but maybe that's because you sold all your stock undervalue, or because you got rid of some costs. Let's say you fired all your employees. So you really need to know, not just to look at the numbers, but to know why the numbers are there and what they're telling you.